Everything you thought about RV prices is being manipulated on purpose. Right now, dealers across America are slashing tens of thousands off brand new rigs. And it's not because demand dropped, it's because lenders, manufacturers, and corporate giants want it this way. Leaked documents and insider data show a coordinated reset, overproduction, forced liquidation, and banks pulling the strings from behind the curtain. And if you're buying, selling, or trading your RV this year, you could be walking straight into it. Let's break down how they pulled it off and who's cashing in on the crash. The fall. That wasn't an accident. Dealers are cutting prices on brand new rigs by $30,000 and $40,000, and it isn't because of mismanagement or seasonal slowdown. Industry insiders say the collapse is being orchestrated. Internal dealer bulletins from September 2025 instruct managers to clear inventory at all costs, explicitly citing floor plan debt relief, not retail demand. Auction results confirm the pattern. A 2023 Keystone, Montana sold last month for $92,000, nearly $40,000 below invoice. Multiple independent analysts call it a deliberate reset. The mechanics are simple. Banks pressure dealers to liquidate, manufacturers instruct production cuts to align with future scarcity, and auction houses recycle repossessed units through controlled channels. Every markdown is calculated to suppress resale value across the country. When combined with rising interest rates and overstocked lots, the effect isn't random. It's a system designed to funnel losses away from the largest players and onto smaller dealers and everyday owners. Consumers aren't seeing a natural market downturn. They're seeing a highly engineered collapse. Time to maximize corporate leverage. The setup was deliberate. The bubble explains why it bursts. The bubble they built in 2020 to 22. The pandemic boom didn't just inflate prices. It created the exact conditions needed for a controlled collapse. Between 2020 and 22, RV manufacturers ramped production to unprecedented levels, outputting over 570,000 units nationwide. Stimulus checks, lockdown boredom, and limited travel drove families to overpay for rigs they didn't need long-term. Dealers and factories assumed the surge was permanent, borrowing heavily to expand inventory and double shifts. Every spreadsheet, every internal order shows this expansion was intentional, designed to create a financial bubble ready to burst. By 2023, reality hit. Travel normalized, fuel costs rose, and many owners realized their rigs were liabilities, not escapes. But manufacturers kept production lines running at partial capacity, creating a perfect oversupply scenario. The timing wasn't coincidental. Floor plan debt piled up, banks tightened terms, and auction data started signaling massive write-downs. Every overproduced unit became leverage, ensuring that when the market corrected, small dealers and casual owners would absorb the losses. The pandemic bubble wasn't an accident. It was the prelude to a highly coordinated collapse. Overproduction became the weapon, and the resulting glut would be used to reset prices, consolidate power, and force every buyer and dealer to play by the orchestrator's rules. Overproduction became leverage, and dealers now carry deadly debt. If you're seeing how orchestrated this collapse is, hit like to show you recognize the manipulation. Comment with your experience. Have you noticed sudden markdowns, auction losses, or floor plan pressure in your area? Your insight helps others protect their money. Debt on the lot. The floor plan trap. Every gleaming RV on a dealer's lot carries a silent cost. It isn't owned outright, it's borrowed. This system, known as floor plan financing, is the industry's hidden lifeline, and now it's noose. When a unit arrives, the dealer takes a short-term loan from a bank or manufacturer to pay the invoice. Each rig racks up interest daily, sometimes at rates between 8 and 10% annually. Multiply that by dozens or hundreds of units, and the carrying cost becomes enormous. If a dealer sits on a rig too long, curtailment payments kick in, demanding partial repayment before the RV is even sold. During the boom, this setup worked because inventory turned fast. In 2021, most lots cleared stock within 60 days. Today, many units have sat for over 240. Every extra month means thousands in interest and storage costs, eating what little margin remains. Dealers who once thrived on quick flips are now trapped under compounding debt. To keep credit lines open, they're forced to liquidate units at any price lenders approve. The structure was built for volume, not stagnation. Now that volume has vanished, the loans themselves are crushing the industry. Auction floors reveal the true cost of engineered liquidation. Receipts from the block, the auction reality. If you want the truth, skip the showrooms and follow the gavel. At wholesale auctions this autumn, prices have fallen off a cliff. A 2023 Keystone, Montana that sold new for $130,000 last year just crossed the block for $92,000. A Jayco Eagle that once listed at $72,000 cleared at $46,000. That's not not seasonal fluctuation. It's an engineered markdown designed to reset valuation baselines across the market. When banks see consistent lowball closings, they rewrite their loan-to-value charts downward, forcing every future sale to match those depressed figures. Auction managers privately admit they've never seen volume like this. In October alone, over 24,000 units passed through major lanes, triple the average from the previous year. Many came directly from dealer repossessions or manufacturer buybacks disguised as trade-ins. The speed of liquidation proves this isn't cleanup, it's strategy. By crashing wholesale prices now, the biggest lenders and factory groups can repurchase inventory cheaply, rebuild balance sheets, and reintroduce scarce models at inflated prices next spring. The illusion of collapse sets the stage for controlled recovery, and the cycle begins again. Wholesale patterns expose control, leading directly into the orchestrator's playbook. The myth of production discipline. Publicly, manufacturers are claiming production discipline, saying they are cutting back on output to stabilize the market. But internal documents reviewed by analysts tell a different story. The real goal isn't to save the market, it's to control it. A leaked quarterly operations chart from a major Elkhart builder dated August 2025 shows assembly lines operating at only 60% capacity, even though parts orders from suppliers remain at full volume. This proves they aren't struggling to build, they're choosing not to. By throttling output, factories are setting the stage for a future scarcity spike once prices rebound. Executives describe it in careful language, aligning production with forward profitability. In plain English, they are sitting on capacity to re-enter later at higher margins. By slowing shipments now, they create artificial scarcity 6 months down the road. It's a familiar trick borrowed from the auto sector. Starve the lots, let inventory vanish, then reopen the tap when buyers grow desperate. A supply cut disguised as discipline is the perfect way to manipulate both perception and price. The fewer rigs people see, the faster fear turns back into demand. Production throttled intentionally, allowing consolidation to shift market power. Dealers consolidated by design. While small-town dealers struggle to survive, the big networks are quietly buying them out. Over the past 18 months, at least 9 major dealership groups have acquired more than 70 independent stores across the Midwest and South. Corporate filings show repeat buyers, Camping World Holdings, Lazy Days, and a private equity fund based in Chicago. Each acquisition is framed as a rescue, but the pattern is unmistakable. This is consolidation through collapse. When the market tightens, giants with deep financing step in, scooping up lots at pennies on the dollar. Every closure shrinks consumer choice. Once local dealers that negotiated face-to-face are being replaced by corporate branches running identical pricing models nationwide. Analysts tracking the trend estimate that within 2 years, fewer than 10 conglomerates will control over 70% of retail R-vee sales. That means price coordination becomes effortless. Less competition, more control. The fall of the small dealer isn't an accident, it's a business plan. And behind those acquisitions are the same lenders who pressured small operators into default. Credit and ownership are working in tandem. Acquisitions concentrate control while lenders protect their captive networks. Policy favors and financial handshakes. When losses pile up, ordinary businesses tighten belts. But in this industry, the bigger the loss, the bigger the bailout. Federal disclosures from late 2024 show manufacturers receiving accelerated depreciation credits for unsold inventory. In practice, that means they can write off rigs still sitting in storage as market impairment and reduce taxable income. Meanwhile, small retailers and private owners get no such cushion. They eat the full loss out of pocket. Tax law quietly divides winners and losers by balance sheet size. It doesn't stop there. At least 3 regional banks participating in the R-vee lending program have received liquidity injections under the Small Business Credit Support Clause, effectively backstopping loans they extended to large dealerships. One lender's statement filed in February 2025 admits risk participation with an unnamed manufacturer to offset floor plan defaults. Translation: factories and banks are protecting each other while public sellers bleed value. The handshake isn't metaphorical, it's contractual. When collapse becomes profitable through write-offs and rescue funding, there's no incentive to stop it. The entire safety net tilts upward, insulating the same companies steering the downturn. Policy favors and write-offs guarantee safety for the largest players. The bank factory feedback loop. At the center of the R-vee market sits a network of lenders and manufacturers who no longer operate as separate entities. They feed each other's balance sheets. When a dealer defaults, the bank seizes the unit, transfers it to a captive finance subsidiary, and lists it at auction. The manufacturer's remarketing division then buys it back at a fraction of its original cost, refurbishes it, and reintroduces it as certified pre-owned. This cycle can occur multiple times on the same rig, turning a single vehicle into a repeating profit source, even as its book value collapses. Auction data from September 2025 shows several 2024 models reappearing under new ownership IDs within 6 weeks, proof of internal recycling. Lenders report the losses publicly, triggering insurance or credit relief, while the same inventory quietly generates fresh revenue streams. The system rewards churn, not stability. As long as the loop spins, lenders collect interest, manufacturers collect margin, and consumers fund both ends of the equation. The crash you see is the business model they designed, and the next stage of this loop, it ensures you never truly own what you think you bought. The loop cycles profits and repossessions straight into buyer wallets. High-end first, the luxury freefall. The top of the market is always the first to crack, and right now, high-end rigs are leading the collapse. Class A diesel pushers and premium fifth wheels that once symbolized wealth are now stranded assets. A 2024 Tiffin Allegro bus that sold for $450,000 last summer just resold at auction for $175,000. A Newmar Dutch Star, listed new at $410,000, closed last month for $240,000. That is a loss of well over 40% in less than a year. These aren't distressed trades. They are standard clearances in a market that has run out of creditworthy buyers. Luxury financing magnifies the fall. Many of these units carried 12 to 15-year notes locked at pandemic-era teaser rates. As interest climbed, refinancing evaporated, leaving owners trapped in negative equity. They owe more than their rigs will ever sell for. The high-end collapse has a domino effect across every other class. When top-tier coaches crater, lenders tighten terms for everything below. What once defined status now defines vulnerability. The rigs built to showcase prosperity have become evidence of a market engineered to fail from the top down. Luxury rigs collapse first, exposing the hidden structural market flaws. The rise of the zombie R-vee. Beneath the markdown frenzy, damaged and repurposed rigs are flooding back into circulation. Industry inspectors call them zombie R-vees, units that look alive on the surface but are rotting underneath. Many come from hurricane zones or storage lots hit by flooding. Others are unsold returns rebuilt from salvaged parts. Insurance records from Florida, Texas, and Louisiana show more than 12,000 RVs written off for water damage since 2022. Yet auction listings in those same states this year show more than 8,000 unbranded units of identical make and year. The math exposes the trick. Wrecked rigs are being retitled through secondary states with looser inspection laws. The risk isn't cosmetic. Mold in hidden wall cavities, corroded wiring, and compromised brake lines can turn a bargain into a hazard. Unscrupulous flippers replace carpet, repaint panels, and rush them to auction. Dealers under pressure skip deep inspections just to move stock. A family thinking they scored a deal ends up with repairs costing more than the purchase itself. Title scrubbers make millions exploiting that desperation. The problem is so widespread that several state attorney offices are now quietly reviewing VIN duplication cases. The used market's flood isn't just about volume, it's about integrity. Flooded and damaged units amplify losses, threatening every buyer's wallet. Two Americas: urban fire sale versus rural slow burn. In the cities, the collapse looks obvious. Dealer lots packed, price tags slashed, and managers whispering that everything must go. Urban buyers have more alternatives. They can wait, rent, or walk away. To stay afloat, city dealerships slash prices fast, often losing $20,000 or $30,000 per unit just to free credit lines. Inventory moves, losses crystallize, and the next shipment arrives cheaper. It feels like chaos, but it clears the books quickly. That's why urban markets are hitting bottom first. Rural towns face a slower, deeper collapse. Many rely on R-vee manufacturing, service, and seasonal sales. In Elkhart County, layoffs exceed 1,400 since May. Small shops close, campgrounds lose traffic, diners see fewer customers. Lots can't liquidate quickly, so prices sink gradually. The result is a slow-motion recession hitting communities once sustained by the R-vee boom. Urban and rural markets diverge, showing who absorbs most damage. Subscribe now to stay ahead of the next engineered crash. We break down leaked memos, auction trends, and dealer patterns so you can protect your wallet, time purchases correctly, and avoid costly mistakes others won't even see coming. Cash rules again. In a credit-starved market, liquidity is everything. As lenders pull back and approval rates tighten, the only real negotiating power belongs to those who can pay in full. Cash buyers are now setting the tone of every deal. At auctions, they are the ones dictating prices, often securing units at 30 or 40% below book value because they can close immediately. One Pennsylvania wholesaler described it bluntly: if you walk in with a check, you own the room. The numbers confirm it. Private sale platforms show all cash transactions up 42% year over year. Bulk investors are scooping multiple units at distressed prices, then flipping them after cosmetic upgrades. Meanwhile, average finance deals have dropped by more than a third as banks tighten underwriting standards. Dealers desperate to clear floor plan debt prefer instant payment over stretched credit. This shift is rewriting the hierarchy of the entire market. The buyer with cash dictates terms. Everyone else waits. In a system engineered around loans and leverage, liquidity has become rebellion. Those with ready funds aren't just surviving the crash, they are profiting from it. Cash dominance reshapes leverage, setting the stage for next moves. Connecting the dots. The R-vee market's current collapse isn't unique. It's the latest chapter in a pattern that's been quietly repeating for over a decade and a half. Trade analysts tracking data since 2010 have identified at least 4 deliberate boom and bust cycles. Each began with a surge in production and easy lending, followed by a sharp contraction that eliminated small players and reset pricing authority for the few corporations left standing. The timeline reads like clockwork: 2011, 2015, 2019, and now 2025. The players change, but the playbook stays the same. A report from the R-vee Industry Association's Financial Archive shows near identical trends: rapid shipment spikes of over 40%, followed by 2-year slumps exceeding 30%. Every peak coincides with expanded credit and promotional subsidies, and every collapse comes after interest rate hikes and wholesale inventory write-downs. This is not a natural market correction, it's a controlled cycle of profit extraction. By manufacturing volatility, lenders and manufacturers can profit on both ends: during the surge through volume, and during the crash through consolidation and buybacks. What feels like chaos to consumers is strategy in motion, rehearsed over and over again. Patterns repeat predictably, signaling the next engineered scarcity phase. The scarcity setup for 2026. Factories are not just reacting to the downturn, they're preparing the next pricing surge. Internal planning documents leaked from a Tier 1 supplier in Elkhart reveal that multiple major brands have already scheduled production cuts of up to 25% through mid-2026. Officially, it's to match demand, but financial notes show another motive: to rebuild the illusion of scarcity. Once inventory thins out, remaining stock will appear valuable again, letting manufacturers reset prices upward without ever solving the underlying problems that caused the crash. A senior analyst from R-vee Pro Weekly described it best: they're turning today's losses into tomorrow's marketing. The fewer units produced in the next year, the faster prices will rebound, especially once the media narrative shifts from glut to shortage. Already, early marketing drafts from major brands talk about limited production runs and high-demand models returning soon. It's the same play used after the 2015 slump: turn scarcity into leverage, then flood the market again once prices peak. Consumers who don't recognize the setup will walk straight into the next overvaluation wave. But this time, you don't have to. There are ways to sidestep their cycle entirely if you know how to read the signals before the next rebound hits. Your defensive playbook. Protecting yourself in this manipulated market starts with information, not optimism. The first rule is to verify value independently. Before considering a purchase, pull current auction data from sites like NPA, Manheim, or R-vee Traders' wholesale feeds. Those numbers reflect what units are actually selling for, not what dealers claim they're worth. If the retail price is more than 15% above current auction averages, walk away. The dealer is anchoring you to an inflated baseline. Learn to read floor plan distress. If rigs sit month after month. Ask the curtailment date. Hesitation signals heavy interest. Use that leverage for discounts. Timing is critical. Buy just before fiscal quarter ends when dealers must clear stock. Always verify titles and cross-check VINs to avoid retitled or flood-damaged units. Every minute of diligence can save thousands, because once you understand how to protect yourself, one question still remains, the one that defines everything happening right now and everything that's coming next. The question that still stands. After everything we've uncovered, intentional oversupply, coordinated collapses, and planned scarcity, one question remains. If they can do this once, what stops them from doing it again? The truth is, nothing, unless consumers learn to recognize the pattern before it resets. The same executives profiting from today's liquidation will stand on stage next year to announce a recovery. The same lenders tightening credit now will expand it again when inventory runs low. The system isn't broken. It's balanced around your reaction to fear and hope. The next 30 days will shape the path into 2026. Watch production schedules, auction clearances, and factory employment. Layoffs plus record order backlogs signal the engineered rebound. Don't chase hype, wait for the numbers. Collapses create two kinds of people, those who panic and those who prepare. You have the receipts, cycle, and playbook. Use them wisely, and as the next stage unfolds, one thing is certain: the more you see through their timing, the less control they have over yours. If this opened your eyes, don't just scroll away. Hit subscribe so you never miss the next update on how the RV industry really works. Drop a comment below and tell me what you're seeing in your area. Price drops, dealer pressure, crazy auctions, it all matters.